2027. No rate cuts until 2027. Bank of America just dropped a bombshell, and most investors are completely flat-footed right now. Here's what's really going on, and what you need to be thinking about before today's market open. Bank of America has issued a stark, unambiguous warning. The Federal Reserve will not cut interest rates until 2027. Not this year, not next year. 2027. Markets are reacting right now. Nasdaq futures are slipping. Dow futures are in the red. S&P 500 futures are pulling back, all ahead of a critical U.S. CPI inflation print dropping today. That CPI number is the pin that could pop this entire setup. One hot print and the rate cut narrative doesn't just get delayed, it gets buried. Goldman Sachs is piling on. They've sent their own blunt message pushing back rate cut expectations. A second major Wall Street institution in lockstep. When Bafa and Goldman are singing the same tune, you don't ignore the melody. The 10-year Treasury yield is staying elevated. That's not noise. That's the bond market telling you exactly what it believes. Higher for longer is no longer a warning. It's the base case. Rate-sensitive sectors are taking the heat right now. Real estate, utilities, dividend-heavy equities, these are the sectors that bleed when rates stay high. They're not priced for 2027. Most portfolios aren't either. But here's what nobody is saying about this yet. The real hidden risk isn't in real estate or bonds. It's in growth stocks. Elevated rates compress future cash flow valuations using a higher discount rate. Translation: the earnings that tech and high-growth companies are promising in year 3, year 5, year 10, they're worth less today when rates stay this high. The Nasdaq has been priced for rate cuts that are now officially off the table for years. That repricing hasn't fully hit yet. The mainstream conversation is about when the Fed cuts. The real conversation should be, what is your portfolio actually worth in a no-cut, higher-for-longer world through 2027? First, review your exposure to rate-sensitive sectors. Real estate investment trusts, utilities, and long-duration bonds face structural headwinds if BofA's 2027 call holds. Second, stress test your growth stock positions. High multiple, long-duration growth names get hit hardest in a sustained high-rate environment. Know your valuation risk before today's CPI print lands. Third, watch today's CPI number like a hawk. A hotter-than-expected print could accelerate this entire repricing. A cooler print might buy temporary relief, but it doesn't change the 2027 call sitting on the table right now. 2027, no cuts. Two major Wall Street institutions are now aligned on that call. What do you think this means for your portfolio? Drop it below. I read every single one. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.